What will lead the central bank to cutting rates? Joining us now, former Dallas Fed President Robert Kaplan. Good morning, Robert.
Good morning, Steve. How are you?
Let's do a little Monday morning quarterbacking after the Fed meeting here. The Fed changed its statement with one word. That was the policy decision by the committee. And then they submitted 19 separate forecasts that led to the market to conclude there'd be not just rate cuts, but 6 rate cuts next year, quarter-point rate cuts, and happening as soon as March. Did the Fed get the communications wrong, in your opinion, Robert?
Well, I think that there was a producer price index report the day of the Fed announcement. And I think that report gave the Fed a pretty good idea that the PCE report from last Friday was going to be very positive. So they submitted a median a number of cuts for next year of 3, but I think it probably gave Chair Powell a little more confidence that we were going to get a good PCE report. And so on the margin, yes, he sounded more dovish than I think he might have liked to, and they've tried to walk it back since. But I think he previewed that the PCE report and future reports might be very strong. And I think if he hadn't done it, it would have happened last Friday. So I think it's on the margin. We're going to wind up in the same place either way.
If you're sitting there, Robert, as a Fed official, which you were not too long ago, you've got a 3% year-over-year inflation rate. You want things to come down, and suddenly there is this massive relaxation in financial conditions. Are you concerned that that leads to reigniting inflation?
Yeah, I'd be concerned about it. I'd also be concerned that government spending is at record levels, and that seems to be having an effect on the service sector, much more on the goods sector. It's causing services sector to be more sticky in inflation there. And I'm also conscious of the fact that you just mentioned that the oil rally has been another tailwind, and that tailwind may not continue. So I think that's why if I were there, I'd want to see at least a couple of more months of reports that suggest the progress that we've been seeing is sustained. But if I saw that, then I'd be ready to take some action, because I don't want the real Fed funds rate to actually go up. And as inflation comes down, if you don't adjust the Fed funds rate, you're actually increasing the restrictiveness of monetary policy. So I'd be prepared to act in the spring.
All right, Robert, I asked you 2 questions about monetary policy from the negative point of view. Let's entertain the positive idea here, which is it possible that the Fed is reversing course just in time to prevent the recession that everybody saw coming, and can have its cake and eat it too, which is to say lower and lowering inflation without a recession, without unemployment going up too high? Or am I just believing in Santa Claus here?
No, you're not believing in Santa Claus. I think that there's a good possibility that we won't have a recession in 2024. The Fed can help with that if it believes inflation is wrestled to the ground. It can help by rate cuts. But the big reason why I don't think I think the economy is going to surprise with its resiliency is, again, we are running deficits that are in excess of 7% of GDP. Spending on the Inflation Reduction Act, the Infrastructure Act, the Unspent American Rescue Act money is all happening in 2024. And so while a number of sectors, the good sector's weak, China's very weak, which helps contribute to that, you've got a strong bid for goods, services, and workers from all this project spending that's going to go on through 24. So I think the Fed's got an excellent chance to be able to cut rates and have a soft landing, but it's got to see more sustained improvement for a number of more months before it acts. But I think that could happen again as early as this spring.